Good morning, everyone. I'm excited to welcome you to today's session. We'll be exploring NISM Series 5A, Mutual Fund Distributor Certification. This is a comprehensive look at the key aspects of fund distribution and channel management practices. Over the course of this presentation, we'll cover various chapters, starting with an in-depth examination of intermediaries. I look forward to engaging with you all and sharing valuable insights. Let's get started. Let's take a closer look at the role of distributors in the investment process. Essentially, they act as the intermediary between you, the investor, and the fund manager. They help bridge the gap, making sure your investment goals are aligned with the right funds. Distributors assist in goal-based portfolio construction, which means they work with you to build a portfolio that suits your specific financial objectives and risk appetite. This personalized approach ensures that your investments are tailored to what you want to achieve. While the distributor focuses on understanding your needs and ensuring suitability, the asset management company, or AMC, handles the security selection, choosing the right stocks, bonds, or other assets to include in the fund. So, in this setup, the distributor ensures that your investment choices fit your goals and profile, while the AMC takes care of the technical, security-level decisions. This division of roles is crucial because it combines personalized guidance with expert asset management, ultimately helping you build a more effective and suitable investment portfolio. Let's take a closer look at the different types of distributors. First, we have individual distributors. These are independent professionals who work on a freelance basis, helping clients make investment decisions and manage their portfolios. They often have direct interactions with investors and offer personalized advice. Next, we have institutional distributors. These include banks, NBFCs, and stockbrokers. They typically operate on a larger scale, serving more clients and offering a range of financial products and services. It's important to note that both types of distributors are required to register with the Association of Mutual Funds in India, or AMFI, through a process called obtaining an ARN, or AMFI registration number. This registration ensures they meet certain standards of professionalism and compliance. Understanding these distinctions helps us see how the distribution landscape is structured, with both individual professionals and large institutions playing vital roles in connecting investors with investment opportunities. Now, let's discuss non-individual entities. These include partnerships, banks, and regional or national distributors. Essentially, these are larger organizations or groups that play a role in our distribution channels. Unlike individual agents or employees, these entities tend to operate on a different scale and structure. Next, it's important to note how earnings differ between these channels. Employees typically earn a salary, which provides them with a steady income regardless of sales performance. On the other hand, subagents often earn commissions, meaning their income is directly tied to the sales they generate. Understanding these distinctions is crucial because it highlights the different motivations and operational models within our channels. Recognizing whether you're working with an individual or an organization helps tailor our approach and expectations. Overall, this slide emphasizes the diversity within our distribution channels and the importance of understanding the different roles and compensation structures. This understanding is key as we look to optimize our strategies and ensure alignment across all partner types. Now, let's explore how we can leverage existing trading infrastructure for mutual fund units. Essentially, investors can use platforms like BSE Star MF or NSE NMFII, which are well-established and user-friendly. These platforms are particularly ideal for investors who already have DMAT accounts, as it simplifies the process and makes transactions more seamless. It's important to note that even when investors buy or redeem units through these platforms, the responsibility for settlement remains with the Asset Management Company, or AMC. This means that the AMC ensures that the transactions are completed smoothly and securely. Additionally, these platforms give investors direct access to buy or redeem mutual fund units, which can be a significant convenience. It allows for quicker transactions without necessarily going through traditional channels. Finally, it's worth mentioning that stockbrokers also play a key role here, acting as distributors. They can facilitate these transactions and help investors navigate the process, making the entire experience more accessible and efficient. Connecting all of this back to our overall theme, using existing trading infrastructure can really enhance the ease and speed of mutual fund transactions, especially for investors already comfortable with stock trading platforms. Today, let's look at the differences between the regular plan and the direct plan. The regular plan includes distribution expenses and commissions within its total expense ratio, or TER. This means that when you invest through a distributor or an agent, part of your costs goes towards paying those commissions. On the other hand, the direct plan has a lower expense ratio because there are no commissions paid. This often results in cost savings for investors who choose to invest directly with the fund. It's also important to note that both plans have their own separate net asset values, or NAVs. This means that the value of your investments in each plan is calculated independently. Understanding these differences helps you make more informed decisions based on your investment preferences and cost considerations, which ties into our overall discussion on how to optimize your investment strategy. Now, let's talk about the traditional use of printed application forms. Many investors and distributors still prefer this method, mainly because it feels familiar and straightforward. Once the form is filled out, the next step is the physical deposit, which is usually made at official points of acceptance, or OPOA. These are designated locations where you can submit your application forms securely and reliably. Despite the rise of digital options, this mode of distribution remains popular, especially among senior investors and those who prefer a more tangible process. It's a method that emphasizes personal interaction and trust, which continues to be valued in the investment community today. Now, moving on to the distribution channels, it's important to note that this slide includes e-commerce platforms as well as online-only distributors. These are primarily digital channels that have gained significant traction in recent years. Next, I want to highlight the SEBI guidelines specifically for execution-only platforms, or EOPs. These guidelines are designed to regulate platforms that simply execute trades based on investor instructions without providing advisory services. A key focus here is on promoting paperless, app-based transactions. This shift towards digital documentation not only streamlines the process, but also enhances transparency and efficiency. The mode of distribution, therefore, is predominantly digital and online, aligning with the broader trend of increased digital adoption in financial services. Overall, these points underscore how the industry is moving towards more streamlined, technology-driven distribution methods, which tie back to our ongoing theme of modernization and digital transformation in the financial sector. Now, let's look at how the transaction aggregating platform works using the Common Account Number, or CAN. This platform is designed to simplify the way we manage our investments across different fund houses. Instead of juggling multiple accounts and statements, the CAN consolidates all your holdings into a single view. This makes tracking your investments much easier and more transparent. Additionally, it enables you to make a single payment that covers multiple subscriptions. So, rather than making separate transactions for each fund or scheme, you can handle everything with just one payment. This system is a key part of MF Utilities, or MFU, which aims to streamline mutual fund transactions and improve the overall user experience. By integrating these features, MFU is helping investors save time, reduce errors, and gain better control over their investments. It's all about making the process more efficient and investor-friendly, which aligns perfectly with our broader goal of enhancing financial inclusion and ease of investing. Let's talk about these new-age investment platforms. You might have heard of platforms like Growa or Paytom Money. These are prime examples of how technology is transforming the way we invest. They are highly user-friendly and accessible, making investing easier for everyone. One of their key features is the emphasis on direct plan investments, which often help investors save on commission fees and maximize returns over time. Another important aspect is the paperless onboarding process. No more filling out endless forms or submitting physical documents. Everything is digital and streamlined. Plus, these platforms offer real-time tracking of your investments, so you can monitor your portfolio's performance whenever you want. Overall, these platforms are making investing more transparent, convenient, and efficient, aligning perfectly with the broader shift toward digital finance solutions in today's world. To become a registered distributor, there are a few important prerequisites to keep in mind. First, you must pass the NISM Series VA certification exam, which is essential to demonstrate your understanding of the financial products and regulations. This exam ensures that you have the necessary knowledge to advise clients responsibly. Next, you'll need to undergo Know Your Distributor, or KYD, compliance. This process helps verify your background and ensures you meet the standards required to operate ethically and professionally in the industry. Additionally, registering with AMFI is a critical step. Once registered, you'll receive an ARN, or AMFI registration number, which identifies you officially as a distributor. All these steps are designed to maintain a high standard of professionalism and trust in the industry, and they form the foundation for your journey as a financial distributor. Remember, these prerequisites are not just formalities. They're vital to building credibility and serving your clients effectively. Let's talk about the Employee Unique Identification Number, or EUIN, which is now mandatory for all applications. It's essential that this number is quoted on every application form we submit. Why is this so important? Well, it helps ensure accountability and transparency in our dealings. By including the EUIN, we can prevent mis-selling and protect both the client and ourselves from any potential issues down the line. This requirement ties directly into our overall focus on maintaining integrity and trust in our financial practices. So, always remember to include the EUIN on every application. It's a simple step that makes a big difference. Let's talk about the request for empanelment with each AMC. It's important to understand that for every AMC you want to work with, you will need to submit a formal request for empanelment. This ensures that the process is transparent and standardized. Now, as part of this process, you'll be required to provide some key documents and details. These include your ARN, which is your Association of Mutual Funds in India registration number, your PAN, which is your permanent account number, and your bank details. These are essential for identification and transaction purposes. Additionally, there is an agreement involved where you will need to confirm your commitment to abide by the SEBI and AMFI Code of Conduct. This is crucial because it aligns you with the regulatory standards and ethical practices expected in the industry. Overall, the empanelment process with AMCs is designed to be thorough but straightforward, ensuring that only compliant and serious participants are part of the ecosystem. This process helps maintain trust and integrity across the industry, which is fundamental to our overall theme of building a transparent and reliable mutual fund distribution network. Now let's take a closer look at the trail commission. Essentially, this is calculated as a percentage of assets under management, or AUM. It's not a fixed fee, but rather a proportion based on the value of the assets we oversee. This commission is paid periodically, typically on a monthly basis. That means our revenue from trail commissions is steady and predictable, which helps us plan more effectively. One of the key advantages of this model is that it discourages churning. That is, unnecessary buying and selling of assets just to generate commissions. Instead, it aligns our interests with those of our clients, encouraging us to focus on long-term service and growth. Overall, this revenue model supports a relationship-driven approach, emphasizing stability and trust. It's a central part of our strategy to foster genuine, lasting client relationships while maintaining a sustainable revenue stream. Now, moving on to some recent regulatory updates that are quite significant. In August 2025, SEBI issued a circular that effectively withdrew transaction charges. This is a notable shift because, previously, these charges were part of the fee structure for mutual fund transactions. What this means is that there will no longer be any upfront commission deducted from investors' investments. Instead, distributors will now be compensated directly by asset management companies, or AMCs. This change aims to make the fee structure more transparent and investor-friendly. It aligns with SEBI's ongoing efforts to reduce conflicts of interest and promote fairer practices in the industry. Overall, this update is part of the broader move towards more transparent and direct fee arrangements, which ultimately benefits investors by reducing costs and increasing clarity. Let's talk about some important regulatory updates from SEBI. They've mandated that asset management companies, or AMCs, need to implement a thorough due diligence process for certain distributors. Now, why is this necessary? It's to ensure that the distribution channels maintain transparency and adhere to regulatory standards. Specifically, this applies to distributors who meet any one of a few key criteria. First, if they have multiple point presence, that is, more than 20 locations, they need to be scrutinized more closely. This is because a broad physical presence can sometimes lead to complex oversight needs. Second, if a distributor has raised over 100 crore rupees across the industry in the non-institutional segment, including high net worth individuals, they fall under this mandate. This highlights the importance of monitoring large-scale fund mobilization activities. Third, if the commission received by the distributor exceeds 1 crore rupees per year across the industry, it signals significant earning potential, which warrants careful due diligence. And finally, if a distributor receives over 50 lakh rupees in commission from a single mutual fund, that's another trigger point. It's crucial to monitor such relationships to prevent potential conflicts of interest. All of these criteria are aimed at promoting transparency and safeguarding investor interests. They tie back to our overarching theme of ensuring robust compliance and ethical practices in fund distribution. This way, we build trust and uphold the integrity of the financial ecosystem. An investment advisor is someone who, for a fee, is in the business of giving investment advice to clients and holds themselves out as an advisor, by any name. It's important to understand that this label signifies a professional who provides personalized guidance on investments. On the other hand, mutual fund distributors registered with the industry association can share investment-related views, but only as a secondary part of their main activity, which is distribution. This means their primary role is to distribute mutual funds, not to act as advisors. A key point here is that a distributor cannot call themselves an investment advisor, because that title is reserved for those who meet specific criteria and are registered accordingly. Also, it's worth noting that asset management companies, or AMCs, cannot pay commissions to registered investment advisors, or RIAs. Understanding these distinctions helps clarify the roles and restrictions within the industry, ensuring transparency and proper regulation as we move through the presentation. Many self-employed mutual fund distributors rely heavily on trail commissions as their main long-term income source. This means that their earnings are often tied to the ongoing business they generate and maintain. When an MFD, or mutual fund distributor, passes away, AMFI has advised AMCs to offer a nomination facility. This allows a nominee, usually a family member or someone designated, to continue receiving the commission on the existing business. The nomination is typically taken at the time of empanelment, so it's important to register a nominee early on. If no nominee is registered, then AMCs may pay the commission to the legal heirs after verifying their succession or legal heir proofs. It's crucial to understand that the commission is payable only on assets mobilized before the MFD's death. It will continue to be paid until the investor changes the ARN or the distributor code. However, it's also important to note that no new business, fresh SIPs, or changes to existing systematic transactions can be made under the ARN of a deceased distributor. This facility is designed to protect the distributor's family from a sudden loss of income and to recognize Trail Commission as a long-term asset that they helped create. Overall, this nomination facility and the continuation of commission serve to support the families of deceased MFDs, ensuring some financial stability and acknowledging the long-term relationship built with investors. Now, let's discuss how Trail Commission rewards work when it comes to changing distributors. Essentially, the Trail Commission not only rewards the distributor for the initial mobilization, but also for the ongoing service, updates, and support they provide to investors over time. Investors have the freedom to change their distributor or even choose to go directly without a distributor at any point. They simply need to submit a written request to the AMC or the registrar, and this process is straightforward. Importantly, AMCs are required to process these change requests without asking for a no-objection certificate from the current distributor, which streamlines the process and avoids unnecessary delays. To prevent any misuse or undue pressure to switch distributors, the industry has put a rule in place. When a distributor code is changed in a folio, whether due to a change of distributor or a shift to direct investment, the Trail Commission stops for both the old and the new distributor for that specific folio. What this means in practice is that, once a change occurs or the investor moves to direct, no Trail Commission will be payable under either ARN for that investor's existing holdings in that folio. This policy ensures transparency and fairness, maintaining the integrity of the commission structure and supporting a healthy industry environment. So, in summary, while investors can switch freely, the Trail Commission is designed to be paid only for the period when the distributor is actively servicing the investor, not beyond that. When discussing schemes, it's crucial to understand what constitutes unethical or illegal conduct. Making a false or misleading statement can seriously distort the truth and mislead investors. It's equally important to avoid concealing or omitting material facts. These are key details that could influence an investor's decision. Additionally, hiding the associated risk factors of a scheme can lead to inappropriate expectations and potential losses. Another vital point is that firms must take reasonable care to ensure the scheme is suitable for the buyer. This isn't just good practice. It's a legal requirement under SEBI regulations, specifically the SEBI, Prohibition of Fraudulent and Unfair Trade Practices Relating to Securities Market, 2003. Overall, these principles emphasize transparency, honesty, and responsibility, core values that protect investors and maintain trust in our financial markets. Remember, ensuring the suitability of a scheme is not just about compliance. It's about ethical responsibility and safeguarding investor interests.